Welcome back to Golden Rule Radio on this fantastic FOMC first meeting of the year, February 1st discussion. And without further ado, what did we hear today, Mr. Torrey?
Yeah, this might come through as old news since the show posts on February 2nd, but we did just get the results of that FOMC meeting and another quarter-point rate hike, as expected, as you just said. And still you get market fluctuations. You get an immediate rally in the equities, you get an immediate rally in the metals, and then some of that equity market rally reversed a little bit, but the metals have stayed strong. Gold posting a new high over 1950, and the NASDAQ really rallied hard, even though the Dow Jones ended up turning down. Some of that has to do with the Facebook better than expected earnings report as well. So you have a few things going on here at the same time, but man, did we see bond yields decline, and as a result, obviously, gold is going to rally as a result of that, and the U.S. dollar. We'll talk about that here in a little bit in the show. But other than that, nothing unexpected, right?
No, certainly not short term. Markets love predictability. In fact, I would almost argue markets prefer expectation over the reality of what continued interest rate rises into the future is going to end up looking like and doing. If you listen to yesterday's FOMC announcement, there was a good discussion about the expectations going forward. We're nowhere near where we want to be. We're still targeting 2% real inflation, which we have a long way to go to get to. We're still going to need to see some austerity in government spending. We're still going to need some tapering in places. You can't just raise the interest rate limit if we're not going to also simultaneously lower the borrowing against it.
That's a really timely comment because here we are, you're seeing the conversations heat up as predicted a month ago on this show with the debt ceiling discussion.
Oh yeah, speaking of raising limits.
Right, yeah, exactly. So do they rein in spending? Well, we'll see. We've got the House Speaker and the President sitting down to talk about exactly that. And you did hear Powell talk about disinflation. So that's where some of the market sentiment was positively impacted, as well, as if the measures they're taking on raising rates is having an impact, and you're starting to see some disinflationary economic numbers. But, ironically, this is the same direction, same rate hikes that started the gold decline and the dollar rally last March, and yet the same direction, same decisions, same rate hikes, even if they're at a smaller scale, are now having a different result. You're seeing the dollar continue to turn down. You're seeing gold continue to rally, which is a 180 degree on each of those aspects or each of those markets compared to mid-2022. So interested to see what happens now here if they actually pause. But I'm with you. Where's the austerity?
Yeah, we've obviously changed the paradigm over the last year. The new normal is interest rates are going up for the foreseeable future. And with that, you expect markets, once they've gotten past their knee-jerk reaction initially to accepting the fact that this might be happening for 6 months, well, it's been 6 months. Now it's a lot easier to swallow it might be happening for another 6 months or even another 6 months after that until we get to some of the levels that the Fed is eventually targeting. So it isn't entirely surprising to me at all on a day where your gut might say, doesn't rising interest rates means the U.S. dollar gets stronger? What do you mean it got weaker today? Doesn't rising interest rates mean that things like gold and other commodities or even the Dow Jones or the NASDAQ get weaker? What do you mean they went up today? It's not surprising to me because those are the directions that you should expect to see things go, at least for the period of time here. Now, I will say I'm not banking on this quite yet. When I look at the price of gold, I see the exorbitant growth that we've had since November without any semblance of taking a breather. Now, do I think we're going to see gold testing the all-time highs again in this year? Yeah, absolutely.
Yeah, I agree with that.
Do I think it's going to happen in the next 3 weeks? I strongly doubt it. So, or at least it's harder to make that prediction. You can make any prediction you want on a long enough timeline. 1,000 monkeys at 1,000 keyboards.
Yeah, and you can't predict the news.
Exactly.
Right? So we're always one news event away, as we say on the show. And you and I have talked a lot about still hoping for, or maybe even expecting a little bit of a breather or pullback. Does that 1920-ish? I'm anxious to hear your technical support levels now that we've hit this 1950 mark here today. But yeah, with rate hikes going on for almost a year straight now, and continued geopolitical strains and tensions. Of course, gold's going to have some wind in its sail. And then again, we talked about those bond yields dropping. That's wind in the sails of gold. But that aside, where are you seeing this potentially bottoming? Is that 19, 20, 24 range still our floor on this cycle?
Short term, absolutely. I mean, maybe a little bit lower. We had that one little dip down about a week ago. But yeah, I think you're still looking at like a short-term trading range between, let's say, 1910, 1920 up to where we are now. If you stay within that range, you've heard me say this a couple times over the last month, reversals happen quickly. Continuations tend to stretch out. So if we do get some sideways trading, 40, 50 bucks up and down, yeah, I think there's a much stronger chance that allows some of the overbought positions we talked about either last week or the week before, I can't remember, but that causes some of those overbought positions to sort of work themselves out over time instead of by declining price. So you can either decline price quickly to clean some stuff out of the markets, or you can just sit stagnant for an extended period of time, and that has the same kind of cumulative effect. So that would be option one. Option one is we see 40, 50 bucks of trading, and I would argue, let's say we see a drop down to 1925, 1930, and then we come back up to 1950 again. I think there's a good chance we end up trading here for a few weeks. If we go down to 1920 and then all of a sudden it's 1890, well, obviously that's a very quick pullback, and now we're looking at the reversal that you and I are hoping for.
Last week you had brought up that image of 5 straight weeks of gold climbing, and now we're in 5 straight weeks of a sideways consolidation in silver. That's that dragging out that you're talking about. But with that gold, does this make 6 weeks in a row? If we close above this 1950, here we could see 6 weeks and 6 weeks of one climbing and one being stagnant. And what's happened in that period of time is our favorite gold to silver ratio has increased, right? That's a technical gold overperformance compared to silver, and that ratio's gone from about 75 to 82 over that same 6-week period of time. So transition that over to silver, you're seeing that sideways consolidation. Yet don't you kind of feel like that's a positive, bullish sort of sentiment and potentially a climb from here? And what are those numbers?
Sure. I mean, let's say we do close up 6 weeks. So that's 6 weeks in a row and 12 out of 14 weeks that gold has closed up. So that's a pretty impressive short-term period of growth in any asset. So let's say we do get that turnaround in gold, and my downside targets are now kind of adjusted up a little bit to like 1820, 1780, and 1740. So that's kind of looking where in the next couple weeks, if we do have a turnaround in gold, maybe we see something like that. Now, when you relate that to what you're talking about in silver, like you said, silver has been turning sideways. It's shaking out some of that stuff that gold probably still needs to do. So you could end up having a decline in gold, but silver stays in its trading range. That's certainly an option, especially because that ratio has come back up into the low 80s, like you mentioned.
Yeah.
We're, 60% above the average? Yeah. Down in the mid 50s. So we're about 60% above the average. We moved down to that average, what was that, about a year and a half ago?
Yes.
So as we're bouncing down towards that average and probably eventually going to swing the other direction, it's very likely you could see another bounce taken here where silver maybe sits stagnant in the same dollar up and down range that it's been because it's already cleaned out a lot of these trades. Whereas gold maybe takes a $100 drop from here.
It seems to need it right now, right? As we get detached from these moving averages and you run in an unarrested fashion with very little pause, we've seen this over and over again just in my tenure, in your tenure here, and it's okay for it to come back down. And some analysts even would define this as what's called an A rise, right? There are some analysts that look at these cycles as an A climb, a B decline, a bigger, much larger C climb or rise, followed by a larger D decline. And so this is just the start. Remember, we washed out the end of that D decline in September, and we've seen this long, steady A rise. Completely normal for us to expect a B type of decline, is it not?
not only is it likely to see, but it should be expected. It's healthy. Even if a market is going the way I want it to, it still makes me really nervous when it only goes the way I want it to. Nothing in life should ever work out perfect for you all the time. It makes me really nervous when it does. Maybe that's just my personality. But if things are going really well in my life, I start looking for the car wrecks coming. I don't know where they are.
Well, sort of like the U.S. dollar wreck, right? If you're a dollar bull or you've got all your
that chart.
I mean, that thing is.
You already mentioned the equities. I'm just going to bypass the equities chart because the equities rally was, other than a couple instances within the text, because when you take an 85% loss over the course of a period of time, great 13% jump, that's just volatility.
No, that's right. And you do have two key things coming out. We've got CPI on the 15th before we transition to the dollar. In regards to those equities, you've got the CPI number coming out in a couple weeks. And then you have Apple, Amazon, Google. They're reporting on the day this show is released, on Thursday the 2nd. So those could show some news that causes those markets to rally. Mm-hmm. But those are sort of false rallies. So I don't want to stick on the equities. Let's go back to the dollar because, man, that's looking like it's almost in a bear market. It's dropped below its 65-week moving average, which was 102.8.
So Powell started raising the rates, first or second quarter last year? Well, when I look at the value of the dollar index, the dollar is at June levels. So almost all, if not all, of the interest rate rises that we've had over the last 6 months, gone. All of the gain in the dollar on the international scale.
Amazing.
Highest interest rates we've seen in decades and nowhere near where we need to get to. And all of the gain we've seen since it started as of today, all gone.
Yep.
So where does the dollar go from here? The stronger the dollar gets, the weaker the dollar gets. I haven't quite fit it together yet. It may go back to the concept of austerity we were talking about earlier.
Yeah, no, that's actually a really good point. And if there's some really strong budget constraints, right? Or there's some talk about capping the debt ceiling at a more realistic number, a more responsible number, you could see that. Because doesn't the argument hold too that the dollar has done opposite of what gold has, and it too is due for a correction the other way, for a little bit of a bounce.
Right.
Right. And that would correspond with that gold decline, those two going at the exact same time, before it resumes its decline and gold resumes its C wave climb.
Yeah, and the dollar's actually starting to plane out here, kind of like, say, silver had done that we were talking about a second ago. The decline in the dollar, we had a big spike up around August, September. Then we had a big spike down in November when gold started going up. And the dollar is logarithmically starting to kind of even out as time goes on, which, again, leads me back to the idea that the longer you stay within a tighter trading range, the less likely you are to reverse, the more likely you are to fall off the cliff again and then do the process over again. So continuations tend to take time, reversals tend to happen very quickly, and the dollar is slowing down its continuation cycle of going down, which makes me think that, I think unless we see some of those other pieces of the puzzle come together with fixing our currency and our economic problems, unless we see some of those other pieces come in, raising interest rates ain't going to fix it by itself.
Well, coming back to silver, more subjectively, I agree with everything you just said, and more subjectively with silver, I'm looking to see which gets broken first, $23.40 to the downside versus $24.40 to the upside. We're really kind of stuck between those two numbers in this range, and it has yet to play out, just like the dollar. Right? Are we going to go up? Are we going to go down? We don't know, but boy, it sure is building some potential energy.
So we'll certainly keep an eye on the markets over the next few days, and we encourage you to as well. What happens once the knee-jerk reaction is over and the markets fall back into their expected trends? I think it's great. You brought up the fact that we've got some additional earnings reports that are going to kick a few things around here over the next couple weeks. And we'll have to see what happens between this week's recording and next. So make sure to catch us again next week on Golden Rule Radio. As always, we appreciate you stopping by. If you'd like to find more info about Golden Rule Radio or McIlvaney Precious Metals, you can find us at McIlvaney.com. We're also on Twitter at ICA Gold or Facebook at McIlvaney Financial. As always, if you want to talk about your personal precious metals portfolio, give us a buzz. We can be reached at 800-525-9556. Thanks for listening. Have a great week.